Welcome to The Explainer. Today, we're cutting right through all the noise in the financial markets. There's a lot of panic out there, right? But is it a real warning sign, or is this just a classic case of fear creating a massive opportunity? We're going to break down the big picture behind the headlines.
This phrase, man, it just perfectly captures the mood right now. You feel it everywhere, don't you? It's in the media headlines, it's all over social media, and it's even showing up in the big market sentiment indicators. It's this anxiety that's just really hard to ignore.
So, to figure out what's really happening, here's our game plan. We're going to walk through these 5 key areas. We'll start with the emotion that's driving all of the headlines. And then we're going to peel back the layers one by one to get to the hard data, the stuff that reveals the true health of the system.
Okay, let's dive right into this feeling. This palpable sense of fear that seems to have its grips on the markets. Where is all this coming from? Look, this anxiety isn't just some vague feeling in the air. It is being fueled by very specific events. You've got the sensational headlines, right? You've got sharp drops in assets like Bitcoin's 6% plunge over the weekend. And then you have the technical indicators just flashing red. I mean, the daily RSI for Bitcoin, which is really just a measure of market momentum, has hit fear levels we have not seen in over 2 years. It's kind of like the perfect storm for market jitters. All right, so when there's this much panic swirling around, the first thing any rational person should do is check the financial system's vital signs. We need to see if there's actual stress where it really counts, or if this is all just, well, surface-level noise. And that is the key question, isn't it? The answer? Well, it lies deep in the core plumbing of the financial world. We're talking about the monetary and the bond markets. If a real crisis were brewing, this is exactly where the cracks would start to show up first. So, let's look at the data. The difference between key overnight lending rates, which is basically the cost for banks to lend to each other, is sitting near 0. You know what that means? It's a crystal clear sign that banks are not stressed for cash. The system is liquid, it's functioning exactly as it's supposed to, with 0 signs of tension. Okay, so the core plumbing is fine, but what about the riskier parts of the system? I mean, if a real crisis were just around the corner, you'd expect investors to be frantically dumping their riskiest debt first, wouldn't you? So this is where we see a huge disconnect. While fear is gripping other assets, high-yield bonds, the ones people call junk bonds because they're higher risk, they are holding completely firm. In a true panic, these would be the first things investors sell, causing prices to just plummet. Instead, they're stable. This is not at all the behavior you'd see from a market on the brink of collapse. And here's another piece of the puzzle. The MOVE index, which is kind of like the VIX for the bond market, is actually falling. This just confirms that the smart money, the folks in the credit markets, are not seeing systemic tension. Things are calm.
Okay, but what about the single most important indicator? Let's look at the one part of the bond market that's the most sensitive to both economic trouble and Fed policy. This is the big one.
So here's the crucial point. This key barometer, the 2-year Treasury note yield, is showing complete stability. If real economic trouble were on the horizon, we would be seeing these yields spike. But they're not. They're holding steady at a support level, and they're stuck below their bearish trend line, a technical ceiling they just haven't been able to break. This strongly suggests the recent market moves are just noise.
So the financial plumbing? It looks solid. But this calm data is happening right alongside a surprisingly strong real economy, which makes all this widespread fear even more puzzling. I mean, when we look under the hood of the real economy, the indicators aren't just stable, they're pointing toward accelerating strength. The yield curve is positive, that's a classic sign of health. Overall economic growth is actually picking up speed. You could even argue we're in the middle of a boom. In this number right here, this is the foundation for the markets. This strong economic activity is expected to drive 10 to 15% profit growth for companies. That is an incredibly strong fundamental backdrop that makes a really long market downturn much less likely.
So, if the system is stable and the economy is strong, why all the anxiety? Well, it seems to be coming from 2 pretty important short-term factors: a temporary drain on liquidity and a potential change at the Federal Reserve.
Let's break down the short-term picture. First, the U.S. Treasury has been building up its cash balance, which kind of acts like a temporary vacuum, sucking money out of the financial system. At the same time, markets are speculating that a new Fed chair could mean lower rates down the road. This all creates a very delicate balancing act. The result could be smaller liquidity injections in the future, which would explain the pressure we're seeing on assets that are most sensitive to cash flow, like crypto and high-growth tech stocks. Okay, with all of that said, let's zoom out. Let's look at the ultimate thesis. It is so important to understand the long-term trend that overrides all the short-term fear and noise. The numbers on the screen, these are the key takeaway. The structural reality is a massive public deficit and a national debt that's over $40 trillion and still growing. Now, this isn't a political statement, it's a mathematical reality that forces certain outcomes. And that outcome? It has a name: monetary degradation. When debt and deficits are this large, structurally, the system has no choice but to create more currency over time to manage the burden. When a government has to spend way more than it collects in taxes, the printing press eventually has to make up the difference, and that consistently erodes the purchasing power of the currency. So, when you put it all together, despite the short-term noise, the scary headlines, the temporary liquidity issues, the fundamental case for owning assets that can't just be created out of thin air remains firmly intact. This long-term trend of monetary degradation provides a powerful tailwind for both hard assets and risk assets over the long haul. And this brings us right back to our central question. When you weigh the short-term panic against the calm market vitals, the strong real economy, and these undeniable long-term fiscal trends, well, you have to ask yourself, is this moment of extreme fear a threat to run from, or is it the ultimate opportunity for those who can stay rational?